You may have heard of Steve Eisman because he was featured in the movie and book called The Big Short. The movie featured a trade that made Eisman hundreds of millions of dollars by betting against the subprime mortgage market. The movie also portrayed Eisman as having a brash personality. This seems to be true, as shown by a 2010 conference call.
But the patience of your shareholders is not infinite, and my patience is just about done. Mr. Fraser said that they might do bolt-on acquisitions. Do not do that. You do a bolt-on acquisition, and I will wage a proxy battle immediately to throw you out of here.
Even Eisman's wife has said, even for Wall Street standards, people think he's rude, obnoxious, and aggressive. But where has Steve Eisman gone today? This video will go through where Eisman has gone and see if he has some magic left in his current stock portfolio. But before we start, welcome to our channel, The Market is Open. Please hit the like button at any time during the video if you're enjoying our content. Also check out our second channel, TMIO Tesla, which discusses Elon Musk's favorite company. Eisman's Big Short trade made sense because he has always specialized in analyzing financial stocks. His career started in 1992 at Oppenheimer, a financial services company. Eisman became a notable critic of the financial sector when he penned a scathing report in 1997 trashing many subprime originators. He opened up a hedge fund in 2004 where his fund exclusively focused on buying and shorting, which is where you make money when a stock declines, financial stocks. Eisman in 2006 listened to a bond trader who convinced him to bet against the US subprime mortgage market. This trade became known as the Big Short, where his firm made 66% in 2007. And at his peak, he managed $1.5 billion in assets. He also became one of the most legendary fund managers of the 2000s. However, in 2011, the firm Eisman worked for, Front Point Partners, was embroiled in an insider trading scandal, and he chose to leave the company and go at it alone. At this time, his star power was quite large, and leaving the firm helped accelerate its total closure in 2011. Now on his own, Eisman ran a fund called Emerus, which he ran until about 2014. This fund managed about $200 million. Notably, Eisman was still only betting on financial companies. However, at this time, he found financial stocks were a bit too limiting and he sought to broaden his horizons. So, he then went into hiding for 3 years.
So I closed my last hedge fund in 2014. I used to just do financials. I decided that was no longer a viable strategy and I wanted to do all sectors.
He then emerged in late 2016, and his new fund had success, returning 11.4% on average per year in 2017 and 2018, which beat out the hedge fund index. As of 2020, he works for Neuberger Berman, where he manages close to $1 billion. While his total portfolio is private, Neuberger Berman wanted to use Eisman's star power to launch a new fund in the United Kingdom. This smaller fund, which is around $40 million, is public and is supposed to replicate his larger fund's strategies. So now we can actually see what Eisman has in his portfolio and see if this portfolio is worth replicating. To use industry jargon, Eisman has a long-short portfolio, meaning he tries to profit by buying stocks that he thinks are cheap and shorting stocks which he thinks are overvalued. Eisman also believes in extreme diversification.
Putting all your eggs in one basket, to me, is not really investing, it's gambling. Because it could work for a while and you feel like a genius, but nothing lasts forever. And then things change and all of a sudden you're losing all this money in your one investment. It's not worth the risk. There's a real concept of just risk reward.
Let's take a look at his whole portfolio and some of his key holdings. The sheet I'm looking at will be linked to in the description. As can be seen, Eisman is a bit overweight information technology, which means he thinks tech stocks will do better than the average industry sector. It's also important to keep in mind his fund is long short, so he has about $40 million invested in stocks, but he's also short about $25 million, meaning he has a bit more exposure on the long side. The industry would say he is net long stocks. Let's dive into the stocks that Eisman has been the most public about holding and see if these stocks are worth owning.
So you're one of the people who have been shorting Tesla, betting against the Tesla stock.
It has not worked yet.
No, it's not worked yet, but it doesn't prevent people. This is the largest.
That was Eisman in January 2019 when Tesla stock was still at $300. In June 2020, its stock is around $1,000, though he says he covered this position at $800 in around early February 2020, according to this interview.
Steve, let me cut to the chase. Are you still short Tesla?
I covered a while ago.
How did you cover? What was the decision tree to make that decision?
Look, everybody has a pain threshold, and when a stock becomes unmoored from valuation because it has certain dynamic growth aspects to it.
Despite covering, Eisman would still be down 100% on this position in 2020, losing 3% of his fund's total money. So, was Eisman right to originally short Tesla in 2019, and covering in 2020, was that also a good idea? Two things can be true at once. Eisman could have been wrong to short an excellent company like Tesla, but the stock may actually now be a bit overvalued at $1,000. Let's explain why Tesla stock is currently overvalued. First, the electric vehicle, or EV market, is expected to be 16 to 24% of all car sales in 2030. If we take the better number for Tesla, that would imply worldwide EV sales of 24 million cars. On top of that, let's build an optimistic forecast where Tesla sales grow by 35% a year until 2029, and they top out at about 10 million in vehicle sales. The 10 million number was chosen because that is a similar number to the largest car manufacturers today, Toyota and Volkswagen. So I'm basically saying, let's agree Tesla probably becomes one of the largest car companies in the world. But here's the problem. 10 million in sales would then imply Tesla would have about 42% of the EV market. This kind of number has typically been unrealistic for the auto industry. The reason is the auto industry has not traditionally been a winner-take-all market like some tech markets. For example, Google makes almost all the search engine revenue, and there is little rationale for an advertiser to use a Google competitor when there is not a lot of traffic on a competitor site. This winner-take-all revenue for some tech firms can justify sky-high PE ratios. So far, the auto industry has never been this environment, and I don't see good rationale why it will become one. Despite this being a risk to Tesla's valuation, let's say they get there anyways and get about 42% EV market share. I have also done a discounted cash flow analysis, which can be downloaded for free on our Patreon page, showing that even if Tesla got to this 10 million number and grew at 4% a year forever, its share price should only still be around $750. There is one more risk. Almost all the other auto companies, until very recently, thought Tesla was a joke, and for a long time, the mighty German automakers didn't take Tesla seriously. However, in 2016, they realized that Tesla could actually destroy them, and they began investing heavily in electrification. Tesla fans currently point out how much better Tesla cars in 2020 as proof that they'll dominate the market forever. However, what they don't mention is how late other auto companies started and how fast they seem to be catching up. Here's an example in 2017 where Tesla is dominating the EV category, and no company is even close to Tesla in terms of range. Range is currently a very important metric for EV car companies as it shows how far the car can go between charges. However, look how much that range gap has closed in the latest report. Okay, so the Germans are still behind, but they started late and they're now investing heavily. Volkswagen will spend $66 billion over the next few years on this technology. Let's also remember, Volkswagen is not some small scrappy startup. It's a highly profitable company, and its legacy business earned $15 billion last year, and this includes $2 billion of losses relating to that 2015 infamous diesel lawsuit. Volkswagen's R&D is 6.7% of sales, or over $16 billion. This compares to Tesla's $1.3 billion, or 5.4% of sales. I'm not saying that Tesla doesn't have a bright future. I'm saying maybe Tesla won't grow at 35% a year, and maybe it won't eventually have 42% market share in the EV market. Having said all of this, I don't think Eisman was right to short Tesla because Tesla is creating more value for shareholders every day. While its shares, I believe, are overvalued today, the company definitely has a bright future. The problem for Eisman, he didn't only short Tesla, he also publicly went very long General Motors.
You don't believe in Tesla, but you do believe in General Motors.
Oh, I actually do.
Yeah. Why?
So far in 2020, Eisman's GM investment is down about 24%, losing his fund 1% of all its capital. He says he likes GM's low valuation.
Bad balance sheet, it's bad management, it's sold at 5 to 6 times earnings. So fast forward, today, it actually has a good management team, maybe even better than good. It has a pristine balance sheet, and it sells at 5 to 6 times earnings.
However, I would debate that last remark that GM actually has an excellent management team. This is because Elon Musk criticized EV automakers in 2014, saying they have created a false perception where an electric car would be ugly, slow, and boring like a golf cart. Despite this rather prophetic quote, many in the media celebrated GM for apparently beating Tesla to market when it launched its Bolt in 2016. While the Bolt was a bit more than a golf cart, GM was definitely telling the world, if you want an EV, you're gonna take some compromises, buddy, and the car has never been popular. So in 2020, GM had to go back to the drawing board. It now hopes to electrify its main fleet like Cadillac. However, the issue is that GM is not only very behind Tesla, but now many automakers. As of 2020, the German manufacturers have put out cars that are somewhat catching up to Tesla. But where's GM's electric car in this list? Well, it did announce in 2020 that it would spend $20 billion on electric vehicles and that it would have 1 million electric cars by 2025. But this claim seems a bit dubious given GM's secrecy. For example, in March 2020, GM showed journalists its new electric fleet, but it did not allow any pictures. Not exactly a good sign. Despite all my negativity, is GM stock worth buying? If we look at GM's adjusted after-tax operating income, adjustments are explained in the caption below. Next, let's say investors want a 10% return and they think GM's revenue will decline at 5% a year, which is actually a bit less than what its revenue has declined since 2016. But to be fair to GM, 2019 sales were hit by a strike in September and October, which did cost them a lot of sales. Still, using this estimate, the automotive value to the equity holders is about $31 billion. If we value GM's financial unit at about its tangible equity, and tangible equity is just tangible assets like cash, but it doesn't include intangibles like trademarks, less all liabilities. So adding this value would add another $12 billion to GM's valuation. Lastly, Eisman mentions the GM Cruise, which is its autonomous driving unit that has recently been valued at $19 billion. GM owns about 80% of this company. We can see two valuations, one valuing Cruise at $19 billion, which produces a share price of about $43, which is far above GM's current price. But if we value the Cruise division at $0, then GM's current price makes sense. In my view, GM stock is not yet cheap enough to buy because its sales decline may be even greater than 5% if it is not successful at launching an electric vehicle. I am personally not yet optimistic that it will be able to do this, given its mismanagement over the years. Let's look at Eisman's next very public investment. He loves to say he is short Canada's banks.
On why he is shorting Canadian banks. Well, he is back with us now for an update following the second quarter reporting season. Steve Eisman is a portfolio manager at Neuberger.
This interview was in June 2019. Eisman said he was still happily shorting the Canadian banks at this time. He will still be happy in 2020 as this position has increased by about 11%. So, was Eisman right, and is he right to keep shorting Canada's banks? Let's look at Royal Bank of Canada, Canada's largest bank, which Eisman believes is overvalued. Eisman does acknowledge that Canadian banks are basically being given an oligopoly by the Canadian government. This greatly helps profitability, making them harder to short. For example, Royal Bank of Canada made $26.2 billion of non-interest income last year. Non-interest income is how much money a bank makes outside of lending. But its non-interest expense, which are costs outside of lending, was only $28.2 billion. This means Royal Bank's non-interest income essentially pays for all its costs, meaning interest on all of its loans are essentially pure profit. Let's compare this to a bank Eisman loves, Citigroup. Last year, Citi had $27 billion of non-interest revenue and $42 billion of non-interest expenses. I think this makes it pretty evident that Canadian banks aren't usually a good short because of the favorable treatment by its government. In addition, Eisman likes to say the Canadian banks have too much leverage.
I mean, they're not levered 33 to 1. I mean, I can't remember offhand how much they're levered. It's probably at least 25 to 1.
Okay.
However, something has changed more recently as Canadian banks' leverage has actually declined. Worse, Canada is a bit of a weird country where the government has $105 billion of loans to Royal Bank. In addition, $100 billion of Royal Bank's loans are insured against any losses. See, the government in Canada also insures the riskiest borrowers. Those borrowers who can't put 20% down, the government has told Royal Bank will cover all those losses because they're insured by the CMHC Corporation, which is a government corporation in Canada. So if you factor in these adjustments, RBC's leverage drops to 19, which is a bit high, but is no longer a red flag. Royal Bank right now trades at 10 times earnings, so it's probably not the best time to short this cheap bank. Eisman seems to have gotten too emotional with this idea that the Canadian housing market will implode.
We have a positive loan loss provision for stage one, and that would crush earnings.
And that would crush
Crush
earnings.
it.
And
Crush it.
While some Canadian housing markets are definitely too hot, it can be seen that Canada and the US have had similar overall increases since 1971. And it's not clear Canada's market will crash. Maybe the values will just stagnate for a while. I like how Eisman is long the big US banks, despite the fact that his positions are down about 29% this year, losing 4% of his firm's money. This is because JP Morgan, the largest US bank, recently showed in an investor presentation how cheap US banks are. And they are the cheapest sector. I personally recently went long JPM, PNC, Capital One. I've discussed this rationale for the investment in this video, and we have discussed maximum bank losses from the recent pandemic crisis in this video. Links are in the description. Eisman says SoftBank is one of his biggest short positions. SoftBank is a Japanese company that people seem to think has no money because of its massive losses in an office sharing company called WeWork. Most people do not really seem to understand what SoftBank is, so we made a video, What is SoftBank? Eisman also seems to be in this crowd because he says in his April 2020 letter that SoftBank is over-levered and that no government will bail it out. Unfortunately for him, SoftBank has investments worth over $285 billion, which compares to about its $85 billion in debts. It also owns $140 billion in Alibaba stock, so it probably doesn't need a bailout. Overall, if we run through his portfolio quickly, we can see that Eisman owns a lot of names, so our review tried to focus on the names he's been the most public about. He definitely has been public about the big US banks, which we talked about and we like. He owns a lot of positions in a bunch of companies. Some of them have done well. Overall, as mentioned, he is very diversified. He does own heavily in financial stocks. The reason is he's definitely a financial expert. The one thing is the Canadian stocks, as we mentioned, the Canadian banks. Canada is a bit of a different market, and he has been talking about Canada imploding since 2013, so perhaps he doesn't understand international financial stocks as well, but clearly he has an impressive resume for financial names. Just looking at a few other stocks, he does seem to be a bit more geared towards value, but then you see a name like Salesforce, so that is an interesting position. Visa is another financial stock. I do like the big tech names that he owns, such as Apple. We discussed this in the video, How Much Has Buffett Lost This Year, when Apple was at about 290, saying that historically I've actually really disliked Apple stock, but looking at it, things like iTunes or their App Store, if you think about it, if Apple just maintains an infrastructure, Apple sort of becomes like a credit card company of the future where all transactions sort of go through their App Store and Google's App Store, and it sort of makes them like a credit card company. We didn't really get to talk about Motorola solutions, even though Eisman has been public about it. It would be interesting to go through. I wanted to go through it, but the video was getting too long. Let us know in the comments if you'd like us to go through it. We do have a third channel where we sometimes go into specific names. I also didn't think Motorola solutions would be popular enough to talk about. Microsoft I own a small position in. It's interesting. This rounds out his long positions. Let's just look at his shorts quickly. We mentioned Tesla. He covered this position around 850. He has been short these educational for-profit companies for a while. That's another thing that we could have talked about, but definitely he doesn't seem to have a big position in any of those. Zillow is another one that he's public about that he's shorting. It's sort of a real estate software company. So when you look for a property to rent it, there's Zillow, who has one of the best websites to find a new property, either to rent it or buy it. SoftBank, we discussed. He definitely has made a lot of money on the British banks. We had already discussed the Canadian banks, and I know a lot of people find financial reviews boring, but he's definitely done really well in financial stocks, and he's actually short more financial stocks than he's long. And T-Rex, I believe he's recently public about. So let us know in the comments if you'd like us to review any more stocks. Overall, Eisman is down about 8% this year. I don't think this is too significantly different than the market, so he could still be a legend. Some of these picks may be good in the future. Let us know if you think he is still a legend, and thank you for watching. Please hit the like button and subscribe.